I just believe over time, Bitcoin will converge toward the S&P times 2 and 50% more volatility in the S&P and 2 times performance, or if the S&P gives you 12% a year, then Bitcoin ought to be 20% a year. And so that being the case, we did this Bitcoin 24 model, and the 24 model is a 21-year model, and my base case is 29% ARR for the next 21 years. And at 29% ARR, you end up hitting $13 million of Bitcoin in 21 years. If you're a Bitcoin maximalist or a Bitcoiner, you shouldn't be investing in anything other than Bitcoin, right? Right? I mean, Bitcoin is you've got an answer. There's one winner. Everybody else is a loser, right? And so the question is, are they going to lose big or lose small? What's interesting is companies that can raise capital to buy Bitcoin and intelligent leverage ideas, like raise $1 billion for 0% interest and buy Bitcoin with it for 7 years.
Michael Saylor starts by emphasizing Bitcoin's consistent high performance over recent years, with an average annual return ARR of around 45 to 55%. He points out that Bitcoin has demonstrated robust returns, outperforming traditional investments such as real estate, equities, or bonds. For Saylor, Bitcoin's ARR provides what he describes as a risk-free return of approximately 50%, which sets a high benchmark for any other investment proposition. In his view, if an investment can't outperform Bitcoin's 50% ARR with the same level of safety, it's not worth considering. The centerpiece of Saylor's long-term vision is the Bitcoin 24 model, which forecasts Bitcoin's trajectory over the next 21 years. In his base case, Saylor expects a 29% ARR for Bitcoin, which, if achieved, would place Bitcoin's price at approximately $13 million per coin by the end of the period. This prediction is grounded in assumptions about inflation, the ongoing demonetization of other assets such as gold and bonds, and the adoption of technological innovations. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The only way to beat Bitcoin is more Bitcoin, right? And and that's why every time people offer you, they pitch you all these business ideas, right? And they're like, well, do you want to invest in this business or that business, or do you want to invest in this real estate? And I say, well, Bitcoin's up 46% ARR every year for the past 4 years. So, and that varies, but anywhere from 45 to 55% is the ARR for Bitcoin. So I think, okay, so 50% is my risk-free return. So are you going to give me a proposition which is risk-free better than 50%? And of course, no one's got a proposition that's risk-free better than 50%. So then the question is, well, how the heck are you going to beat better than Bitcoin? And the answer is, the only good idea is borrow a bunch of money for 5% and buy Bitcoin with it. Right? If you can borrow money for 0% or 1 or 5 or 10% and you're buying Bitcoin and it's returning 40 or 50%, then that's a good idea. So I think Bitcoin's a good idea. I think different ways to securitize or lever Bitcoin, some are bad ideas, like, for example, trading 20x leverage on Binance on Saturday night. That's not a good idea. Trading on FTX, on the crypto exchanges with mark-to-market massive leverage is not a good idea. But, if you can take a 30-year mortgage at 3% interest and buy Bitcoin with it, that's a good idea. And, and maybe... You remember, you lived through the many epics. The last epic is about a 45 to 50% ARR. The previous ones were higher. And I think it's the law of large numbers says that as Bitcoin approaches the market cap of the S&P index or the market cap of all the equities in the world, it'll start to approach an ARR and a volatility which is lower, I don't think it'll ever get to the performance of S&P. I think it'll always be better than the S&P index. And I think like right now, the ratio is like 46% for Bitcoin versus 12 or 13% for the S&P. So it's like 3.5x performance, and it's like 2.5 vol. So the Sharpe ratio is higher, right? There's a higher Sharpe ratio of the S&P. The performance is much higher. And I just believe over time, Bitcoin will converge toward the S&P times 2 and 50% more volatility in the S&P and 2 times performance, or if the S&P gives you 12% a year, then Bitcoin ought to be 20% a year. And so that being the case, we did this Bitcoin 24 model, and the 24 model is a 21-year model, and my base case is 29% ARR for the next 21 years. And at 29% ARR, you end up hitting $13 million of Bitcoin in 21 years. So that being the case, coming back to every pitch I get, okay, well, you have a pitch. Can you guarantee me 29% ARR risk-free? And another way to say it is, that's the risk-free rate. So can you give me 39% with no additional capital required for the next 21 years? And if so, it's still not a good idea because it's a distraction, right? Right? It's still a distraction. I'm taking risk, but it's maybe an interesting idea. But of course, as soon as you set that as the cost of capital, 29% risk-free. I mean, the risk-free fiat rate right now is 5%, right? Or actually after tax. Really, the risk-free rate has got to be the after-tax bond yield. So maybe it's 3%. So it's 3% if you think conventionally in fiat terms. But if you're thinking Bitcoin terms, it's 29% for me. You can have a different forecast. But it's very clarifying, right? Because as soon as you actually set that, you think, well, there's really nothing that interesting to me other than what's interesting is companies that can raise capital to buy Bitcoin. And intelligent leverage ideas, like raise $1 billion for 0% interest and buy Bitcoin with it for 7 years. Like those ideas are interesting to me, but there has to be Bitcoin on one side of the idea, and the other side of the idea needs to be an arbitrage of the extremely cheap fiat interest rates.
A key aspect of Saylor's argument revolves around the evolving macroeconomic landscape. He explains how different asset classes will respond to factors such as inflation, innovation, and capital markets. Saylor is particularly bearish on bonds and gold, viewing them as outdated forms of wealth preservation. In contrast, he believes Bitcoin is poised for explosive growth due to its decentralized nature and technological superiority. For Saylor, Bitcoin represents the future of global capital, and investors who fail to recognize this risk missing out on the most significant wealth creation event of their lifetimes.
There are assumptions about the inflation rate, macro inflation rate over the 21 years. There are assumptions about the innovation rate. And then there are assumptions about the monetization or the demonetization of various asset classes. And if you look at that slide, what you can see is we're assuming a progressive demonetization of gold.
Yep.
And a demonetization of bonds and to a certain degree money. But, we're assuming that there's going to be innovation, and equities will benefit from things like technology and AI. Like, for example, if all the cars in the world drive themselves, or you can manufacture humanoid robots, then maybe you'll see companies that have no employees, but they sell millions of humanoid robots made by robots. So the equity will be valuable. So there's some asset classes that look like they'll grow, that we think will grow faster than others. And art, like there's, you can look at that variety of different ways. Maybe you think art will be demonetized faster, in which case you go tweak that. And in this particular case, this is showing it creeping at 9%, but you could view art as gold and decide it's only going to creep at 5. Or we just figured art would be better marketed, and it's prettier than gold over time. We're thinking, but anybody can go and adjust these things and make their own assumptions about what'll happen, and then they can come up with their own macro view of the world. That's what's cool about the model. And I would definitely encourage you, Safe, to grab the model, look at the assumptions, tweak it, and come up with your own Bitcoin view and your own macro view. Because I think when you start to ask the question, how does equity sit with real estate, sit with bonds, sit with currencies and art and gold as a long-term store of value? That's very interesting. I mean, I think you've encouraged all of us to think that way. And, I just see the world as there's a bunch of assets that have utility value. And then there's assets that are primarily store of value. And if you think about the portion of, our long-term capital, our store of value, clearly that ought to be moving toward Bitcoin much faster. And then, everyone's going to want to have their place to live and things that they like, that they brag about, their trophy assets. My self-image is I own the football team. Right. And so some people will pay a lot of money because the idea of being the owner of the New England Patriots is worth billions of dollars to them if they're a citizen of Boston or something. So there'll be things like that. But ultimately, clearly, Bitcoin is global capital, and it's the best asset. So we think it'll grow the fastest. And that model, my base case there is 0.1% of the wealth in the world growing to 7% of the wealth in the world. But go ahead from there, with the caveat that you're working with my base case and you can have your own. It's everybody can have their own assumptions. I think that the S&P index and that equity indexes will continue to appreciate. And I think if you look back, the money supply versus the S&P has been pretty correlated. So if the M2 money supply expands at 7%, I would expect that equity will track that. And here, this is a bit bullish. There's an assumption here that equity will outperform the money supply, but you can come up with a bearish assumption where equity underperforms the money supply. I mean, clearly, this chart is we're a bit bearish on bonds. Bonds aren't growing as fast as an asset class. Real estate is tracking. Equity, we're kind of bullish on. Art, we're a little bit bullish on. Maybe we shouldn't be. And then gold, we're very bearish on. And Bitcoin, we're, triple bullish on. So that's what this assumption is. I don't think the bonds are going away, Safe. I think as long as we have nation states and we have cities and states, they're going to borrow money and they're going to keep expanding the sovereign debt, and I think there'll be corporate bonds as well. So I don't think they go away. And I don't think equities go away unless we lurch into a socialist, more communist type state. I think the argument in favor of equity values going away is you have to basically argue that the state will move to expropriate, regulate, and tax out of existence the equity values, and they could. So this is kind of a bullish on capitalism, right? This forecast, like companies invent stuff and they're able to keep their earnings, right? So it's a fairly bullish on creativity, very optimistic about technology innovation, optimistic about capitalism, optimistic about transformation, pessimistic about the opportunities for gold. Art's a small thing. I don't really know one way or the other, but at the end of the day, it doesn't really matter that much, given the fact that my advice, if you're a Bitcoin maximalist or a Bitcoiner, is you shouldn't be investing in anything other than Bitcoin, right? Right? I mean, Bitcoin is you've got an answer. There's one winner. Everybody else is a loser. Right. And so the question is, are they going to lose big or lose small? And if you came to me and said, oh, I'm going to find a strategy to short the bond market, I would say, I don't suggest that either. You might lose your shirt. So I don't know how to short, or I don't know it's very wise to be shorting most of these things.
Saylor emphasizes that every investor must approach asset allocation with an understanding of long-term store of value dynamics. For those committed to Bitcoin, other investment opportunities become mere distractions. Whether it's real estate, stocks, or bonds, Saylor argues that none can provide the same level of performance or security as Bitcoin. In his eyes, Bitcoin is the only real store of value that makes sense in the 21st century. Saylor wraps up his analysis by advising investors against shorting markets like bonds, as these attempts to predict short-term fluctuations can lead to significant losses. Instead, his recommendation remains clear. Focus on accumulating Bitcoin, as it is the only true hedge against inflation and global economic uncertainty. He sees no other asset that holds the same long-term potential as Bitcoin. Please like and subscribe my channel.